Hello everyone and welcome to Northline. I'm Amir. On this channel we cut through the noise. We look at financial reports, industry data and hard numbers to understand what is really happening in the markets, especially in the world of technology and AI. No hype, no pundit opinions, just the facts from the companies at the very center of it all. Today we are tackling one of the most important questions investors are asking right now. Is the AI boom still going strong or are we seeing the first cracks? Instead of relying on headlines, social media speculation or analyst opinions, we are going straight to the source. We are diving deep into the latest quarterly results from Taiwan Semiconductor Manufacturing Company, better known as TSMC. TSMC's second quarter fiscal 2026 earnings provide one of the clearest, most unfiltered snapshots of real-world AI demand. And after poring over the numbers, the conclusion is straightforward and highly bullish. The demand for AI infrastructure remains exceptionally strong, and it is showing clear signs of acceleration. Let's break it down step by step with the actual figures. Before we get into the specific numbers, it is essential to understand why TSMC is such a powerful indicator. Unlike NVIDIA or AMD, which design cutting-edge chips like GPUs and accelerators, TSMC doesn't design chips, it manufactures them. It is the world's largest contract chip maker, holding a dominant majority share of the global pure-play foundry market. Major players like NVIDIA, AMD, Apple, Broadcom, Qualcomm, and hyperscalers building custom ASICs all rely on TSMC to fabricate their most advanced designs. This positioning makes TSMC the ultimate central hub of the semiconductor supply chain. If demand for high-end AI chips surges anywhere in the world, it eventually shows up in TSMC production lines, wafer starts, advanced node utilization, and revenue mix. Strong results at a single software or chip design company might reflect isolated success, but sustained accelerating demand at TSMC reflects broad-based orders from dozens of customers across the entire ecosystem. That is why TSMC's reports gives us one of the most important barometers for the overall AI investment cycle. Let's simplify the AI supply chain to see exactly how capital translates into TSMC's results. At the top, hyperscalers like Microsoft, Meta, Google, Amazon, and Oracle are pouring tens, likely hundreds of billions of US dollars into building massive AI data centers. These facilities require enormous amounts of compute power. They buy AI accelerators from designers like NVIDIA and AMD, alongside custom silicon. These designers send their chip blueprints to TSMC for manufacturing on advanced process nodes. Meanwhile, memory specialists like Micron, SK Hynix, and Samsung supply high bandwidth memory which gets packaged together with the processors using TSMC's advanced packaging technologies. The result: aggressive spending by hyperscalers flows downstream to the chip designers, then directly to TSMC's fabrication plants, while boosting memory demand in parallel. When TSMC reports a strong advanced node revenue, high utilization and raised guidance, it confirms the entire cycle is healthy. Now let's get into the numbers from TSMC's latest results. TSMC reported second quarter revenue of approximately $40.2 billion US dollars, hitting the absolute high end of their guidance range. This represents a massive 36% year-over-year growth, marking a new quarterly record. June alone saw revenue break the usual seasonal pattern, hitting an all-time monthly high. First half 2026 revenue reached roughly $75 billion US dollars, up over 35% from the same period last year. But the revenue beat is only part of the story. Management significantly raised expectations for the rest of the year. For third quarter fiscal year 2026, they guided revenue to between $44.6 and $45.8 billion US dollars, implying a strong sequential growth. Full year 2026 revenue growth is now expected to be slightly above 40% in US dollar terms. On the earnings call, leadership emphasized that demand for AI-related products continues to outpace supply. They expect AI accelerator revenue to roughly double this year. These are not the comments you hear from a company seeing softening demand. Gross margins remained exceptionally strong and profit hit record levels. A deeper look at TSMC's technology mix provides even more evidence. Leading-edge processes now account for a record 74% of TSMC's total wafer revenue. This includes substantial contributions from their 3nm node alongside the initial highly successful ramp of 2nm technology. These advanced nodes are precisely what is needed for the most powerful AI GPUs and high-performance computing chips. In fact, high-performance computing revenue accounted for 66% of total revenue in second quarter. The expansion of this high-margin advanced node mix signals that cutting-edge AI production is not just continuing, but accelerating. TSMC is currently capacity constrained on key technologies like advanced packaging, which is critical for AI accelerators. One of the strongest signals of long-term confidence is capital expenditure. Semiconductor manufacturing is incredibly capital intensive. Companies do not commit these sums lightly. TSMC has now raised its 2026 capital expenditure guidance to $60 to $64 billion US. This is a massive increase and it reflects multi-year visibility into AI demand. A significant portion of this is going directly toward advanced processes. Additionally, TSMC announced another $100 billion US investment in its Arizona facilities to ramp up 2nm production, bringing their total US commitment to $265 billion. They are expanding globally to meet demand while diversifying geopolitically. These investments are not speculative. They are backed by customer commitments and a strong order visibility. If demand were fading, TSMC would not be accelerating fab builds and equipment purchases this aggressively. So why should this matter to you as an investor? TSMC's results offer a diversified ground-level view of AI infrastructure spending. When demand flows through TSMC, it reflects orders from a wide range of players: NVIDIA's latest ramps, AMD's new series, custom silicon from Google and Broadcom, and more. This gives a clear, unified picture of the overall cycle. While valuations can fluctuate and competition is always rising, the underlying fundamentals remain rock solid. Based on the latest data, record revenue, raised full-year guidance, a surging advanced node share, and sharply higher capital expenditure, there is little evidence that underlying AI infrastructure demand is fading. Instead, it appears firmly intact and accelerating into the second half of 2026 and beyond. Here is the clear takeaway from TSMC's second quarter fiscal year 2026 report. First, hyperscalers and cloud providers continue investing at record levels in AI data centers. Second, chip designers are shipping and ramping advanced processors at scale. Third, memory suppliers are seeing parallel demand surge. And fourth, TSMC is operating at very high utilization on leading-edge nodes, backing this growth with over $60 billion in capital expenditure and global fab expansions. Taken together, these signals point to an AI investment cycle that is not only intact but accelerating. The fundamentals remain exceptionally strong. If you enjoyed this data-driven breakdown, you will love my deeper dive into NVIDIA's latest results, where we analyze their revenue, margins, and what it means for the broader AI ecosystem. You can check that video out right here. If this was helpful, please like the video, subscribe for more breakdowns based on real financials and industry data, and drop a comment on what company or topic you would like covered next. Thanks for watching, and I will see you in the next one. Stay informed, stay objective.